Welcome to TheoTrade. This is Don Kaufman. November 18th, 2022. Just about 15 minutes to go to the cash close here on this Friday afternoon. Hey, this week amounted to, well, a bit of a slop fest. The big question, of course, at least on my mind, is this going to be a calm before another volatility storm? I'm going to try to answer that, of course, on this weekend's update. Let's actually get started here on the weekend update with, as I said, markets, they pause. No breach in the SPX. I mean, what did the entire trading week really break down to? For that, I'm going to go specifically to the SPX, the mother of all products. And again, I like to put a little perspective in terms of some of the price action on the week. Well, the markets, they didn't just pause. They completely stalled out. So after last week's blistering CPI, come on, it missed by 0.2%. Nevertheless, we had this just rip and rally. What have we done? Not much. I mean, for the most part, we've had now 1, 2, 3, 4, 5, 6 trading sessions. We've done absolutely nothing. In fact, if you actually looked specifically at where we started last week, and again, just want to mark this up on the right there. That was basically at 39.90 inside of the S&Ps, and here we are at 39.68. So, well, this is exactly what I would call massively unchanged. And in a situation like this, first of all, it's tough to allocate. It's always going to be tough to allocate when the market's not moving because you're right in the exact same standard deviation. Now, sure, everybody likes to make arguments, for this, and you're like, well, but my Apple, it moved really because again, for the most part, we had a bit of a slop fest. I mean, this is everything just chopping around, and one of the key points to be made is everything's been moving in relative unison. The correlations are still relatively high. And we're going to show you a little bit of divergence here, though, in just a moment. But again, another key takeaway and something that has not occurred in a substantial period of time, if you were looking at the SPX along with me here, look, there was no breach to the upper and or lower edge of the expected move. Now, the last time that occurred, you got to go all the way back to August, and it is right here. Okay, the week that started August 1st was the last time that we saw, a veritable slop fest. And the irony was that was actually following a rip and rally as well. Nevertheless, this is the first week in a very long time that we've actually had, if you will, a little bit of a calmer week, a bit of a pause. And it's exactly why I'm kind of looking at it and going, I'm like, uh-oh. Is this about to turn into something maybe a little bigger? So again, markets kind of pause. Now, the next thing I really wanted to mention is some of the data that came out this week. And, some of the data that came out with cooling inflation and so forth. And then we had, PPI and there's CPI. But this is what I call living in the upside down, and it's something we're going to be dealing with an extensive amount, especially in the weeks to come here. If you even look into next week, of course, a holiday trading week, there's still plenty of data like durable goods, plenty of data that can absolutely rock this marketplace. And I caution you about what I term, again, living in the upside down. And if you haven't heard me use that phrase before, well, get used to it. It's a phrase I'm actually using a lot right now, and it is actually a reference to the show Stranger Things. I don't care if you like it. What the upside down basically is, it's like this alternate universe, alternate reality where, good is bad, bad is good. But here's the thing, and living in the upside down, it means, for example, cooling inflation. So cooling inflation, and I was talking about this earlier in the week, cooling inflation, you're like, yes, that means the Fed might actually cool off the rate hikes, except that the Fed this week specifically said, yeah, we might cool them off, but we ain't home yet. I mean, Bullard even came out and was talking about a 5.5% terminal rate. That basically means raising the Fed fund futures much higher than they presently are. Nevertheless, when you're talking about living in the upside down, I just mean when, some bad news comes out, hey, what happens if the jobs report hits in a couple of weeks, or retail sales comes out right around the holiday, which we're coming into here, Black Friday, retail sales numbers start to be generated out of that. And what if they're bad? Okay, are we actually still going to be in this alternate take where bad news is actually good for the marketplace? And if you're kind of curious, again, when I am going to get, a little bit more constructive, a little bit more positive about markets, it's when we stop living in the upside down. Because here's the thing, to me, all right, this week, there's one thing that told me a lot, and it was Target. It was the price action in Target, which ironically has rebounded a little bit. And it's actually why I wanted to talk about this again. Target is, to me, reality. All right, it missed. Okay, the stock got absolutely pummeled. They've warned substantially about softening. Okay, in the retail sales, and it goes on and on from there. But cooling inflation to me is not the reality. Cooling inflation is just, listen, sooner or later that's going to happen. But missing the CPI by 0.2% means absolutely nothing in the grand scheme, because again, you're going to see a much weaker economy. That's what the Fed is trying to do. So Target's reality, cooling inflation's not. And it's one of the reasons that I don't think I did a great job of really hammering this home on Wednesday night's video, but it's one of the reasons that I remain pretty steadfast with negative delta in my portfolio. Why do we have negative delta in the portfolio? Why am I actually short a couple of stocks? Okay, simply because Target's reality. Things are going to weaken, things are going to soften. And when they do, okay, and companies start coming out and they start warning and, like layoffs, I mean, look no further than something like Meta, okay? Here's where I talk about like the upside down. Big layoffs, don't worry, the stock actually rallied on it. Of course, there's cost savings and so forth, but at what point, again, do we stop living in the upside down and start living in what's going to be reality? When bad news really is bad news, good news really is good news, then I'll grow a little bit more constructive on this marketplace. All right, I wanted to get that out. Next thing, let's have a look around at a couple of sectors, because there's a few things that have in fact changed this week, even though we slopped around in the S&Ps. And you know what? I'll actually start with the S&Ps. We slopped around in the S&Ps, and we're going to close somewhere around 39.75. But people, look, it's just a hop, skip, and a jump off a number that I happened to mention on Wednesday night's video. On Wednesday night's video, I mentioned 39.31. We hit it. Okay, and it's what we term a gravity point. That's a really pivotal level inside of the S&Ps right now, and we just don't really seem to be very far off of it. Listen, 30-40 handles in this market, please. It just means nothing. So I wouldn't read too deeply into any of the price action that happens specifically in the S&Ps. However, okay, there is a little bit, as I said, like a cause for concern. That's why I'm saying, are we at a calm before like another hardcore volatility storm? Because the dollar, it flattened out. Like, again, like an eerie calm fell over the marketplace. The dollar flattened out. All right, neither here nor there. The bonds, what did they do? They still kind of rallied back up. The last two trading sessions, they backed off a little bit. Again, we're like almost at this pause point where you're like, what are we going to do from this point forward? Volatility. And I've been pointing this out. Like, people look at it and go, oh, volatility is way down. Really? Because the way I look at it, if you look back over the last 10 years, that volatility is sky high versus where it has been over the last 10 years. Like, this is actually still some rockin' volatility. Listen, call me, okay, when the VIX gets down to like 18, I'll be like, wow, the VIX has really collapsed. By the way, 18 is still above where my mouse is. 18 is still above where it has been constructively over the last like 10 years. The last 2 years, okay, have been, living in the upside down. It's chaos, people. Anyway, that's important to understand, that the volatility has not per se abated. So as I actually cruise around a little bit, and we're going to look at some risk assets as well here in a moment, okay, one of the things I noticed in terms of sectors, and I'm actually going to bring up the entire Nasdaq here, albeit briefly. We're going to bring up the Nasdaq. We're going to go to auto expected moves. Because in the Nasdaq, where do we finish the week? Well, right now, for the most part, we're massively unchanged inside of Nasdaq. What I found interesting is Nasdaq kind of held it together. But at the exact same time, you should look over at financials. Okay, if I bring up auto expected moves in the financials, were you aware that the financials actually crested to the lower edge of the expected move, crossed outside of it, okay, and are actually finishing the week, even with today, they're bid up by 19 cents, but lo and behold, okay, they're going to finish the week lower. Okay, and quite a bit lower. So that is absolutely marquee. The other marquee, okay, area in the marketplace has been the energy sector. The energy has been, well, unequivocally unstoppable. But take a look again at auto expected moves. Where are we finishing? Lower edge of the expected move. These are, to a degree, significant. They're significant because the S&Ps cannot and will not progress to the upside. Like, it doesn't matter that they're up 10 right now, okay? They won't progress to the upside without the help of energy and without the help of the financials. Sure, maybe we start rotating back into technology, like, oh, technology really got beaten up this year. We start rotating into tech. It's not going to be enough. Remember something, okay? Energy over the last 5 to 10 years has been nowhere. Meaning, in terms of market capitalization, energy hasn't meant very much. And I want to back up for 10 years, because if you look at energy, it's an absolutely nothing. The reality is, yeah, energy had a bit of a rally here, and it's all the way rallied back to almost where it was in 2014. It's not that energy really rallied, and it is rallying though this year. It's that everything else got absolutely annihilated. And you have to start to look at products, okay, like ExxonMobil again. Why do you have to look at them again? Well, if you take over and look at the phase scores here and go to stock highlights, it became a $460 billion company. And that's, to me, worth looking at, because then you look at stuff like Meta, and it became a $300 billion company. So lo and behold, the ExxonMobils, the Chevrons of the world over there, they matter now. And they matter now more than they have in the better part of almost a decade. So have a little respect for the fact that energy financials, if they continue to see that roll, okay, even into early next week, yeah, you're going to start to actually face quite a bit of volatility again. All right. Another area, and this I have some discontent with what's going on right now in terms of like Skew. Skew is absolutely starting to pick up again. And if you listen, I don't want to go total geek fest on you, but if you don't speak geek, Skew is the out of the money put implied volatility versus the out of the money call implied volatility. And right now, Skew has picked up on a percentage basis. And just a couple of trading sessions ago, it hit 110, which is the lowest ever recorded for Skew. That basically meant there was no like intensity in buying out of the money puts. Right now, the intensity of buying out of the money puts is picking up, which is indicative of hedging activity. It is. All right, that's what it kind of means. But at the exact same time, to counter that, look at what we call vvix. This is the volatility index is all the way down at the 78 handle, which for all intents and purposes is basically one of the lowest levels that we've seen vvix ever. Right? I mean, I can bring up the last, 10 years, any recent time, you have just not seen vvix this low. And what this basically implies is the volatility index, hey, bottom line, trade is not running, okay, to hedge positions using VIX. If they were running to hedge and using VIX, you would actually see vvix a little higher. So it implies that, okay, with Skew going higher but vvix not moving, they are actually hedging in a product like the SPX. They're buying puts inside of the SPX, but they're not necessarily, okay, buying calls in VIX to actually mitigate risk. But there is some hedging activity starting to kind of bleed through in this marketplace a little bit, which again leads me to the belief like it's a pause right now in the marketplace, okay? But that's the best we've seen in terms of Skew in some time. And again, do not let that fall, okay, by the wayside. Like Skew alone, in my opinion, just doesn't mean a whole hell of a lot. But as the Skew starts to pick up, okay, all right, some people are starting to reach for some puts out there. Why? Okay, trying to actually control some of the downside risk of their portfolios. Another aspect, I was talking about energy a moment ago, and it would fail to really do it justice without actually also bringing up oil. Oil, okay, has actually taken quite a bit of a hit this week, and albeit it's just off some of the very recent lows. In fact, it's worth bringing up fairly significant chart on this because losing like the mid 75 handle could be a straight shot all the way down to 60. That's not, again, this to me is recessionary. And I think that oil should be paid very close attention to, because they're like, people are cheering oil selling off. They're like, yeah, it's cooling inflation. But once again, living in the upside down is why people like you cheer for like recession. Oil is selling off. Yes, that means we're really screwed right now. But the Fed won't raise interest rates much because we're really screwed right now. And that's the reality, okay, of oil selling off, coming into the closing bell of the week. And that's the week. All right, so moving along on this front. So again, you had Skew picking up. Next, holiday trading. So let me actually just give you a quick feel for holiday trade. Holiday trade, you're going to trade Monday, Tuesday, Wednesday. Thursday is closed, of course, for the Thanksgiving holiday. Friday will be a half a trading session. Just wanted to get, everybody on the same page with that. Listen to me. Don't get off your game. Don't get off your game just because you're like, well, the volatility is going to be what? Okay, where's the volatility going to be? And we're going to look at this once again. It's about 73. Okay, you just can't get off your game. Volatility has collapsed down for the better part of next week. Nevertheless, okay, that's exactly why I'm telling you right now, again, get on your game and realize we can make a big move. All right, so get your trade on. So this week was pretty mellow. I took a big hit in the JP Morgan trade. What's a big hit? So I had a JPM flyby. Flyby! It's a 1x3. Okay, it's a 1x3x2 butterfly. It actually expired deep in the money. And what's going to happen is long, short, long. For those of you that do not speak complete and total geek, so our position over here is +1, -3, okay, +2. So we're going to end up long 100 shares here, short 300 shares here, long 200 shares there. What is it going to do? It's going to cancel out. What am I going to make? Absolutely nothing. I'm actually going to take a little bit of a loss in here, but we initially put the trade on for a credit. Okay, so net, I'm taking about okay, $1.40 hit on that particular trade. And again, I like to cover my losers first. The next thing I wanted to show you, okay, is the TheoTrade small portfolio. And the TheoTrade small portfolio, this is actually trading options on futures. Well, here, we took off the 3090s. The 3090s, we took that little monkey off right there for about a 50% gain, about a 50% gain. You can actually see my fill. I originally opened this trade for $20 and change. It's now closed for $10.25. Covered that one, actually exited the hedge for $4.45. We're out of the contest. Okay, that was really, okay, kind of the two trades of the week. I also had on an SPX butterfly. I don't mind mentioning this. I had an SPX butterfly. I paid a whopping 40 cents for this. Okay, 40 cents for the butterfly. Ugh, I missed. So I lost 40 cents. 40 bucks. Now, what are some new trades that I've actually got on? One of the new trades that I put on throughout the course of the week, a couple of new ideas in here. I actually put a bearish in-out spread on Google. Okay, let me zoom into this one for just a second. This one's already working, so I probably would not suggest you get into the trade. I bought the 100 puts, sold the 98 puts against it. So this is an in-out spread. It was one strike in the money, one strike out of the money. Okay, this one's already seeing pretty good degrees of profitability at this particular point in time. And the spread tracker over here, Google's up about 15%. Next trade I wanted to introduce you to, welcome to the Catapult. All right, as I said, each and every week, okay, big portion now of these weekend updates, it's going to be what? Get your trade on, the week's profits and losses. And I'll tell you what, again, because we're slopping back and forth, JP Morgan I took a hit on. The MES, which is my premium selling, I actually made a couple of bucks on. I lost on the SPX trade. Net though, I mean, hey, listen, we're ahead of the game now on Google, but I wanted to actually bring into scope the Catapult. And what is the Catapult? The Catapult is actually going out and selling premium in the S&P options on futures. Now, this is a fairly sizable trade. It does tie up $10,000 of margin. This one could actually also be done in the micros. Instead of tying up $10,000 of margin, I could be tying up $1,000 of margin. So I wanted to let everybody know that right off the bat. You don't have to have big margin. But in this particular trade, we're already up a few $100. Okay, so what I'm doing is I'm selling premium in the S&P options and futures to buy a spread in Netflix, to buy a spread inside of Tesla. Here's the interesting irony. All three of them are actually profitable already. Okay, the inception of these trades, well, let's take a look. When did I actually put the particular trade on the 16th? Here we are on the 18th. Okay, they've been on for 2 days. We've got a trade that's up 18%, the Netflix trade up 33%, the Tesla trade up 17%. And what these trades are designed to do, okay, the Netflix trade is a bearish spread. The Tesla trade is a bearish spread. Those trades are actually financed. Of course, I'm buying the spread, but those two trades are actually financed via selling an S&P option on future. Why do I do it? Well, look, if I'm dead wrong and the entire marketplace rallies, so be it. I still collect the premium on the S&P option on future. I would lose on Netflix. I would probably lose on Tesla. But if the market were to start to tank, I would make money on Netflix, make a little bit of money on Tesla. I could possibly still make some money on the S&P options and futures because I sold all the way out to the 3140 put, okay? But if we were to tank big time, I would make a bunch of money on Netflix, a bunch of money on Tesla, and I would actually hedge and reduce risk of the put that I sold in the S&P options and futures. Welcome to Catapult, people. You're going to be hearing a lot more about it in the very near future. Catapult is a kind of a form of dispersion, which is a strategy that's been around for really for decades. But again, it's a couple of new ideas I wanted to throw at you. So there are 3 trades actually done in conjunction with one another, all 3 seeing degrees of profitability, and even mild size. It's still got decent profit and loss over here. Again, since inception, each one of these trades has actually produced pretty good P&L. So what do we do with that? Well, I'm going to be monitoring it, take you through it to some detail in next weekend's update and throughout the course of the week here at TheoTrade. All right, last but definitely not least, we always look at the SPX portfolio, of course, and that is, well, the expected moves. And the expected move of the SPX, this previous week, we had a $99 expected move, but that's a full 5-day trading week. Okay, $99 higher, $99 lower. We came close. We did not tag the lower edge of that expected move. Nevertheless, this next week, and it's not set yet because we're only 6 minutes after the close, but this next week we are approximating at about $73 of movement. However, this next week we only have 3.5 trading days. So, as I said, before you get off your game, okay, understand you have less trading time, but also understand there is economic news, and living in the upside down, okay, this volatility is going to rock from 16 and probably get a lot higher, okay? I'm just going to tell you right now, from where I stand, it is the calm before another volatility storm. It may not necessarily transpire right this next week, okay? But you can anticipate there is still some violence left in this marketplace, unequivocally. So this next week, again, coming into Thanksgiving holiday, hey, fantastic. Maybe we make through, the week without some tumultuous volatility, but I'm telling you, any one of the new data points that comes out throughout the course of this week can actually trigger an absolute crap storm in the marketplace. The week after that, almost unequivocally, you got jobs numbers coming out. Okay, it's going to be a free-for-all. Get ready. Another volatility storm. Okay, it's a great time to reposition yourself, be comfortable with your positions, wrap that risk tight. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.